My YouTube subscriber, Rakesh Gupta, was looking to change his job from an existing investment banking operations role to private equity fund. So he asked me whether it's a right decision to make and to make a video on more topics around private equity. He was confused whether they will ask questions about private equity waterfall distribution, what is the structure, when does management fees have to be paid, when does performance fees have to be paid, what kind of instruments do private equity companies invest in, etc. So that gave me the idea to prepare the second video on private equity 2.0, which talks about which gives an overview of the structure of private equity firms, what they do, how do they invest in companies, and how are they wound up as well. Do you aspire to get into high finance, the dazzling world of markets, private equity, hedge funds, venture capital? Are you keen to join a private equity fund? Are you curious about accounting and valuation at these entities? If your answer is yes to them, then please remember to look at this video. This is Private Equity 2.0, a video that will talk about the structure and the distribution of the private equity fund. I'm a learning partner, Sushila Hariharan. And if you're interested in a career in fund accounting, OTC derivatives, corporate actions, and trade life cycle, do subscribe to my YouTube channel. What is private equity? Private equity refers to funds that invest in unlisted stocks. As you know, there is private equity and there is public equity. Public equity refers to equity shares or stocks that are listed on a recognized stock exchange. Those shares that are not listed are called as private or unlisted stocks. Private equity funds provide capital to issuers, and the issuers are private unlisted companies. Typical investors are private equity funds. Okay, so a private equity fund is an institutional investor that ropes in capital, and this institutional investor then invests in unlisted stocks. PE funds typically take significant stakes in their portfolio companies. The stakes could be so significant that they could also get a seat on the board of directors. Private equity is structured like an asset management company. AMC or asset management company comprises a general partner as well as limited partners. There could be multiple limited partners. In some cases, limited partners could be as high as 10 in number or sometimes even more. The general partner plus the limited partner together contribute the capital of the private equity. This contribution of the capital is typically in the proportion of 3 is to 5% by the GP. The LPs contribute the rest of the capital. So GP, general partners, also contribute some bit of capital and the LPs contribute the rest. Together, the capital is pooled in, and this pooling of capital has a lock-in period that could range between 3 years to 5 years or sometimes even as high as 7 years. Private equity uses this pooled capital, okay, to invest in unlisted stocks. The capital which is contributed by general partner and limited partner. These entities are called as accredited investors, investors which have a minimum net worth of X million dollars, and they invest largely in unlisted companies. So, what defines the agreement between the general partner and the limited partner is called as the limited partnership agreement. The LPA is signed between the GP and the LPs. The LPA clearly states what should be the term of the fund, whether it's going to be 7 years, 10 years, and if there is any provision made for extension of the fund. The LPA will also define the fundraising period, the period during which capital is contributed between the LP and the GPs. It will also define the investing period, the period during which the fund will make investments. The LPA defines these phases as well: the fundraising period, the investment period, the harvest period, and the exit and closure. This is very important because it then defines a timeline to the different structures and the different phases of the private equity fund. The fees are classified as management fees and performance fees. Management fees is typically a percentage of capital contribution, which can be between 1.5 to 2% of capital. It is charged annually, it is paid sometimes quarterly or even monthly. The management fees is mandatory. There is no escaping the management fees. Performance fees, on the other hand, is a percentage of outperformance of the portfolio. This is between 15 to 20% of the profits. And the performance fees is structured in private equity as a distribution waterfall. Distribution waterfall defines how the profits and the capital are going to be returned to the LPs. In the first case, it is the return of capital. Once capital is returned, we then talk about prefs or preferred returns. The third tier is catch up tranche, and finally, carried interest. Return of capital: all investors are returned their capital. There is a recovery of investment for all the investors. Prefs or preferred returns: every investor has its own hurdle rate between the LP and the GP, between that specific LP and that GP. This is the minimum returns to the LP. The catch up tranche is the GP's turn to start claiming its share. It's favorable to the GP. The GP then is able to kick in the carried interest. 80% to the LPs and 20% to the GP is normally the distribution of whatever is left over after capital distribution, hurdle distribution, and profits. If you like the content on my channel, subscribe to it please, so that you can get content rich, research centric, focus on fund accounting, corporate actions, trade life cycle, and OTC derivatives. Thank you very much.